Just keep buying Part-4, invest now or wait for a market crash? A big bonus arrived in 𝐼𝐻𝐻𝐿's account. He decided to invest, but the market was at a record high. He felt a crash is just about to come, a little waiting would be better. Weeks passed by and the market kept moving upwards. With every new height, 𝐼𝐻𝐻𝐿's fear changed. Now more than the decline, the fear of missing the opportunity was troubling him. Finally, gathering courage, he put in the entire money. The very next week, the market fell. The screen was red, and 𝐼𝐻𝐻𝐿 felt as if the timing of his every decision is wrong. This is an investor's most restless puzzle. If money is available today, should we invest immediately, deploy it gradually, or wait for that perfect crash which might come late? In the previous part, we understood that a broad index can be much simpler than the prediction-filled game of individual stocks. Instead of choosing rare winners, it lets you keep them in the portfolio. But diversification also does not give a guarantee of profit. After choosing the right asset, a new fear comes forward. What will happen if you bought the right investment but on the absolutely wrong day? Nick Maggiulli's core idea is that the sooner money meant for long-term investing is put to work, the more time it can get for growth and compounding. There is an important caution here. It is not fixed for the stock market to always go up. History has shown growth in the long run, but future returns are not written in any contract. In the 20th century, the American market saw wars, depression, recession, oil shocks and political crises. Still, the level of the Dow increased greatly from the beginning to the end of the century. Equity markets of other countries also build wealth in the long run, although the experience of every country, every decade and every investor was not identical. Some markets took years to recover. Behind the long positive trend of the market are businesses' earnings, innovation, and economic growth. In exchange for taking part in this uncertain growth, the investor expects returns. That is why the benefit of investing early is not just getting a lower price. The real benefit is time, that time in which returns can be reinvested to push compounding forward. Cash is not useless. It gives emergency cover, near expenses, and mental security. But if more cash than required lies around for years, then inflation and missed growth can become its price. Therefore, invest early does not mean putting every rupee into the market. The amount for an emergency fund, money needed soon, tax and essential bills should remain separate and easily available. Situations like high-interest debt or unstable income can also change the decision. Investable money is only that which does not have to be pulled out when the market falls and for which sufficient time exists. Now imagine a simple thing. You get a large amount and there are two paths, investing it fully today or dividing it into many parts and keeping it in cash for a long time. If the expected return of assets is higher than cash, then its expected outcome will be better by getting exposure for the full amount first. But expected does not mean a fixed result at all. In Vanguard's global market research, immediate lump sum investing outperformed the strategy of dividing and deploying over a short duration in approximately 2/3 of historical periods, but not every time. This comparison was for an amount already available beforehand, not for an SIP formed from a monthly salary. And past performance does not decide the result of any next year or any country. The reason for this lead was not some secret indicator. The amount that kept waiting could not earn the potential risk premium of the market. This is called opportunity cost. But 2/3 also has a second meaning: lump sum did not win every time. If a big decline comes immediately after investing, then money deployed gradually can look better for some time. This is the real fear of a lump sum. Your entire amount will be in the market's ups and downs from the first day, so an initial decline can produce deep regret along with financial loss. Cost averaging can reduce this regret. By deploying an identical amount at fixed intervals, some units are bought at higher prices and some during a decline at lower prices. Its expected return can often be a little less, yet that strategy is useful, which keeps you stuck to your long-term plan instead of panicking and selling everything. Here, two different situations should not be mixed. Holding a lump sum available beforehand and regularly investing a new amount from every salary are not the same financial decision. Doing an SIP when the salary comes is not a delay, because future salary is not even present with you today. You are investing money as soon as you get it and building discipline. An automatic SIP reduces the need to take decisions repeatedly. Whether the market is up or down, the process keeps running and the investor can avoid the mistake of stopping the contribution by looking at the news. But upon deploying a bonus, inheritance or investable cash accumulated beforehand in installments, the remaining amount waits. Here you are choosing temporary safety in exchange for the probability of return. If deploying gradually is what lets you make a start, then first fix the dates, amount, and the final date. The schedule should be short and clear, so that fear does not turn it into an endless wait. I will deploy when the market calms down a bit. This is no plan. The market often feels safe when the price has risen, and most scary when the opportunity looks cheap. News, elections, interest rates and valuations can be important, but telling next month's return is a different job. Good information also does not give a guarantee of a perfect entry date. Considering a crash certain by looking at a record high is also a mistake. A rising market makes new heights repeatedly on the way. A decline comes after some peaks, the next height after many. Asset allocation should be fixed before timing. The mix of stocks, bonds and cash should be such that you can handle even in a bad market without changing goals. The 60/40 portfolio of the book is only an illustrative example, not a formula for everyone. Bonds can reduce volatility, but due to interest rates and credit risk, they can also fall. The right mix is not decided alone by your age. The date of the goal, income stability, dependence, financial capacity to tolerate loss, and your behavior in a decline, everything matters. If you sell by looking at a normal decline, then the portfolio is perhaps more aggressive than required. It is better that risk is reduced first, rather than waiting to change the strategy in the midst of panic. Now let's come to the second part of the story, volatility. If you have to stay in the market, then the price going up and down is not a defect. It is a natural part of uncertain ownership. Volatility and permanent loss are different. The changing price of a broad market can be temporary, while a loss caused by a wrong asset, fraud or selling out of compulsion can remain forever. The maximum a market falls from its high level in any year is called the maximum intra-year drawdown. This shows the deepest fear in between, not the return at the end of the year. Now imagine, you have a magical genie. He does not tell the final return of the next year, but tells beforehand how much the biggest decline in between will be. You ask him, at how much decline in a year should we leave stocks and choose bonds? 5%, 15%, or 40%? Even a safe answer can cause damage to wealth. Avoiding every year with a decline bigger than 5% sounds wise to hear. The problem is that small corrections are normal and can come even between years with good returns. The market can fall first in any year, then recover and close in profit. Just by knowing the deepest drawdown, it is not known where the year will after all end. In the book's historical backtest, the 5% avoid drawdown strategy kept the investor out of stocks in most years, therefore a very large wealth was missed compared to buy and hold. The lesson of this experiment is not that a decline is good. The lesson is that the pain of the path and the return of the destination can be different. One is not decided by looking at the other. If you can identify the rare year with a very large decline beforehand, then staying out can be beneficial. In the book's sample, a severe threshold saved from only a few crises. But this is the whole problem. We do not get the next year's drawdown beforehand. Choosing the correct threshold is easy after looking at the chart. The same information is not present in real time. The better historical cutoff of 15% appearing in the book is not a trading rule. That is the hindsight result of an old sample, not a reliable prediction of the future. In a new period, returns, interest rates, taxes, and trading costs can change. A strategy looking beautiful in a backtest can break down in real life due to delay, emotion, and wrong signals. We do not have a magical genie. Therefore, market timing often demands two difficult decisions: when to exit before the decline and when to return before the recovery is complete. Even if the first decision becomes correct, the second can be wrong. The investor is happy escaping the crash, but loses the sharp rebound waiting to come back. Some strong days of the market often come around turbulent times. Sitting outside due to fear can save from lost days, but also from essential days of recovery. That is why it is wrong to consider volatility as a punishment. Uncertainty comes with the probability of getting a higher expected return. If every outcome was fixed, the expectation of extra return would also be less. Still, making a decline into an exciting story is not right. A broad equity market too can fall very deeply, and no investor is told the date of recovery beforehand. Safety is not built on a day of panic. It is built before by preparing an emergency fund, a low-risk place for near goals, and a diversified portfolio for long goals. Instead of changing everything on the basis of prediction when the market falls, rebalancing can be useful. In this, the portfolio is brought close to the pre-decided allocation without claiming to know the future. Stocks give the probability of growth, bonds can add some stability and income, while cash remains for immediate needs. The job of every asset should be clear beforehand. But diversification does not mean that bonds will definitely rise in every crisis. Different assets can sometimes fall together too. Safety improves probability, it does not make loss impossible. Small rules of managing behavior can make a big difference. Automating investment, keeping price notifications turned off, and reviewing the portfolio at a fixed time, not every hour. Make a written crash plan too. Whether the contribution will continue or not, when the market falls, when rebalancing will happen, and the money of which goals not to touch. This should be decided beforehand. If a lump sum is available today, then make the decision not from a forecast but from the capacity to maintain the plan. Immediate investing often gives a better expected outcome. Staging can reduce initial regret. If you invest slowly, do not change the dates. If you do it all at once, do not consider the next day's decline as a failure of the decision. In both paths, discipline is more important than perfect timing. The real lesson of this part is straightforward. The right time to invest is formed when the money is truly for the long term, safety is prepared, and the asset mix is favorable to your risk. But what if that very fear comes true as soon as you put in the money? Headlines are screaming, the job is in danger, and the market is continuously falling. Then how will just keep buying be possible? In the next part, we will know the truth of buying in the midst of a crisis. Where will the money come from in a falling market? How much to buy? And which mistake turns a cheap price into a costly lesson?
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.